Hello, it's me, Oscar from Marijuana Garden.
The proposed 2025 tariffs by Donald Trump align with several financial management and corporate strategy theories, particularly in trade policy, risk management, and competitive positioning. The theory, proposed by Alexander Hamilton and later refined by Friedrich List, states that new or emerging domestic industries need temporary protection, such as tariffs or subsidies, to compete against established foreign rivals. When applied to Trump's tariffs, industries like steel, aluminum, and semiconductors could benefit from being shielded against foreign competition. These tariffs justify restrictions on Chinese goods to allow US tech and manufacturing sectors to grow. The theory suggests that governments can use tariffs and subsidies to help domestic firms gain a competitive advantage in global oligopolies, such as semiconductors, electric vehicles, and aerospace. In practice, Trump's proposed tariffs of over 60% on China aim to weaken Chinese dominance in electric vehicles, batteries, and technology. This approach encourages the reshoring of supply chains, for example, companies like TSMC building US fabs due to geopolitical risks. From a financial management perspective, firms may restructure supply chains to avoid tariffs. This could increase short-term costs, but over time reduce long-term geopolitical risks. According to the theory of mercantilism, a nation's wealth is maximized by exporting more than it imports, with tariffs being used to discourage imports. Trump's approach reflects this theory, as he believes that reducing the trade deficit, especially with China, strengthens the US economy. However, this view ignores modern economics, which shows that trade deficits do not necessarily indicate economic weakness. For example, the US experienced significant growth despite trade deficits in the 1990s. Financially speaking, this is similar to a company reducing its dependence on suppliers to improve margins. However, if suppliers retaliate, such as China banning US agricultural imports, revenue streams could face significant disruptions. Alright, so here's the theory. In trade negotiations, reciprocal actions like matching tariffs can actually force concessions. It's a bit like a game of chess where each move is carefully calculated to elicit a specific response from the other side. For example, take Trump's reciprocal tariff plan. The idea was to match other nations' tariffs on US goods. This approach was prominently used during the trade war between the US and China in 2018 and 2019. China retaliated, of course, but eventually deals were negotiated. It's a clear demonstration of how this strategy plays out in real-world scenarios. Now, from a financial management perspective, this is a high-risk, high-reward strategy. It could lead to better trade terms, but it could also escalate into a full-blown trade war. Honestly, it's not unlike corporate brinkmanship. Think of Tesla's price wars. They pressured rivals in much the same way. Okay, moving on to risk management and supply chain resilience. Here's the theory. Both firms and nations need to find a balance between cost efficiency and risk mitigation. For instance, over-reliance on a single country like China can create vulnerabilities. In practice, tariffs are often used to incentivize diversification. This can mean moving production to places like Mexico, Vietnam, or even back to the US. It's a strategy that aligns with concepts like friendshoring, as emphasized by Biden, and decoupling strategies aimed at reducing dependency. From a financial management standpoint, this approach means accepting higher operational costs today in exchange for reduced geopolitical risks down the line. It's sort of like how firms started holding extra inventory after COVID to avoid shortages. The principle is the same. Pay a little more now to avoid bigger problems later. Sometimes tariffs aren't just about economics, they're a form of political messaging. You see, behavioral economics shows us that trade policies can serve as signals to certain voter bases or political allies. For example, Trump's base responded strongly to his tough on China rhetoric, even though the economic gains were, well, a bit unclear. It's kind of like corporate buy local campaigns. They're as much about perception as they are about actual economic impact. From a financial perspective, this kind of signaling can create short-term benefits. For instance, after the 2018 tariffs, US steel stocks saw a noticeable boost. But here's the catch: long-term uncertainty from such policies can deter foreign investment. It's a tricky balance, isn't it? Now, let's dive into an interesting concept, the tariff version of the Laffer curve. The idea is that at some point, increasing tariffs actually reduces revenue because trade volume drops or smuggling ramps up. It's a bit of a paradox, but it makes sense when you think about it. For instance, a 10% across-the-board tariff might raise revenue effectively, but a 60% tariff on China, well, that could backfire. It might lead to more evasion and less trade overall. It's a fine line to walk, much like setting prices in a business. Financially speaking, this is similar to a company raising its prices. There's an optimal level where revenue peaks, but push it too far and demand collapses. Tariffs work in much the same way. Interesting, isn't it? When it comes to trade policies, there are always trade-offs, financial ones in particular. Let's break down some key strategies and their implications. For example, protecting an infant industry might boost domestic sector growth, but it could also lead to higher consumer prices and inefficiency. Reciprocal tariffs? Sure, they might create fairer trade terms, but retaliation could hurt exporters. Decoupling from China could reduce geopolitical risk, but it might disrupt supply chains and increase costs. And then there's the simplicity of a 10% across-the-board tariff. It could boost revenue, but it risks inflation and reduced competitiveness. As you can see, each choice has its own set of benefits and risks. So what can we take away from Trump's tariff strategy? Well, it draws heavily from protectionist principles, game theory, and even risk management strategies. It treats trade policy like corporate competition. In the short term, this approach can lead to stock boosts for protected industries and possible revenue gains. But in the long run, most financial theories suggest higher costs, inefficiency, and let's be honest, the potential for trade wars. It's a complex puzzle, isn't it? Now, here's a question for you. Would you like a deeper analysis on how specific industries like tech, agriculture, or autos could be financially impacted? Let us know, and we'll dive right in.